America's central bank has cut interest rates by a quarter of a percentage point. The US Federal Reserve voted to reduce rates for a third time in a row, down to a range of 4.25 to 4.5%. But the bank has signalled rates will reduce at a slower pace in 2025 as it attempts to bring inflation under control. Well, for more on this, I'm joined by AMP Chief Economist Shane Oliver. Good to see you, Shane. So this was an expected move by the Fed, but what does it tell us about where the US sees the economy heading in 2025?
Well, that's the key aspect about this. There was no surprise in the 25 basis point cut. But what has surprised the investment markets is that the Fed was a lot less dovish. It was foreshadowing 4 cuts next year based on the so-called Fed dot plot. That's the expectations of Federal Reserve officials as to where interest rates would go. So it was factoring in another 1% in terms of cuts, or 4.25% cuts. Now it's only factoring 2 cuts as we go through the course of next year. So it's a much more cautious, gradual approach to getting interest rates down. And that partly reflects expectations that the US economy will be stronger. It's revised up its growth forecast for this year and slightly for next year. And of course, there'll be a slower pace of decline in the rate of inflation compared to what they were previously expecting. So the Fed still thinks that disinflation is on track, but at a slower pace. So therefore, it's going to be cutting interest rates more gradually than previously foreshadowed.
I think I know what you're going to say, but does it increase the chance of a rate cut here?
Not really. I don't think it has much in terms of ramifications for Australia. I think if the Fed had said, well, we're not going to cut rates at all, disinflation has slowed, that may have made it more difficult, perhaps at the margin for the RBA. That might be a bad signal for them. But I think in the great scheme of things, the Fed still cutting is consistent with the Reserve Bank ultimately moving. But of course, the Reserve Bank will say that they focus mainly on domestic conditions and they remain key. If we get some lower inflation numbers in the next month, particularly in late January for December quarter, and the jobs numbers look less strong, then I think we could get a cut in February, or if not, probably by May. But the Fed's decision doesn't really impact that either way.
Hey, Shane, have you been across the markets this morning? Are you looking at the Australian dollar? It's been absolutely tanking in the wake of that decision this morning.
Yes, that's it's partly because, say, if the market was expecting a full 1 percentage point in rate reductions by the US, that takes US interest rates potentially below our interest rates. The money market had factored, say, 2 or 3 rate cuts in for Australia next year, 4 for the US. That would have taken US rates below our levels. Now, of course, that's not the case. The money markets are seeing less cuts in the US going forward than we see in Australia. That, of course, has put downwards pressure on the value of the Australian dollar, which, of course, was already under some pressure. So the drop in the dollar is largely a US dollar story. Drop in the Aussie dollar is largely a US dollar story, reflecting expectations that US rates will stay higher for longer, making it more attractive for investors to leave their money in the US rather than put it in Australia.
Shane, there wasn't much good news in the mid-year budget update. With the deficits that are forecast now, do you think it rules out any chance of any further tax cuts?
Well, it probably does. There was certainly a depressing reading that we saw yesterday in Australia. We already knew that we were heading towards deficits. But of course, the last few years, those deficits have become smaller and turned into surpluses. This changes that. For the first time in 2 years, the numbers are actually looking quite a bit worse. And of course, a big chunk of that, $17.5 billion over 4 years, was due to policy changes. That's active decisions by government to spend more. And a small portion of that, about $4.5 billion, was due to changes in so-called parameters, economic assumptions and demand for things like veteran services and so on. So these numbers are a little bit depressing. They maintain, I guess they keep that deficit profile in place rather than seeing improvements. That, of course, has several implications. It keeps our debt levels at higher levels. It also means bigger government in the economy. We're locking in higher levels of government spending compared to the pre-COVID period. And at the margin, it probably makes things a little bit harder for the Reserve Bank than would otherwise have been the case. If we didn't have all this government spending, I think the Reserve Bank could have been cutting interest rates by now.
Shane Oliver, really appreciate you coming on the program. Good to chat as always. Talk to you again soon,
Thank you.
hopefully.